Today we have a new deal. We're looking at over 130 deals at this point, but our new deal today is a Dollar General in Sylvania, Alabama. We have been hot on buying higher cap weight retail deals. Right now, this one we've got for around an 8.7 cap rate. So very excited about that.
And when's the last time you saw a Dollar General traded an 8.7 cap rate?
We have not for a while.
Well, like December, I think, because we bought some other ones.
We bought a couple. So that's been our target lately, has to say what locations are top performers, meaning they have a lot of foot traffic, they have a good lease in place, and they're trading for a higher cap rate. And right now in the market, there's not a whole lot of those. On the Dollar General front, there's almost none on the entire retail front, but Dollar General at least has some of them that we're able to get. And we're excited today to talk about this one.
Right. So
going for us.
Remember, we have a whole criteria we go through. So our Dollar General strategy is there are roughly 700 or so Dollar Generals for sale at the end of last year. We take that $700 Generals, we find out which ones have top performing placer data, so we narrow them down. So that's anything in the 60th percentile and above. And then we take cheap rent, because Dollar General always likes cheap rent. Cheap rent and good performance is always going to ensure that renewal. Yeah. And so we're taking the top tier Dollar Generals and we're finding the ones with cap rates in the eights, and those are the ones we're making an offer on. And so that 700 inventory of Dollar Generals then could become like 10 or 20 or 30 Dollar Generals. Yeah. And those are the 10 or 20 or 30 that we're actually interested in buying right now. And this is one of those in Dollar General in Sylvania, Alabama. This is one of our premium Dollar Generals.
Yeah, and we look at our price point on rent, immediately of $700 Generals, we wipe out 60% because they're kind of the bottom chunk of performers, right? And then from there, we're going to wipe out all of the ones where the rent is in the double digits and higher. Like once you get to like $14, $15 and higher per square foot, that's too expensive for our underwriting. So we wipe those out, and then we're left with deals that are very strong performers because they have cheap rent, they have great foot traffic, and they're then trading at a higher cap rate. So we really narrow down the field of what we're interested in buying.
And don't forget, it's also very important to understand that Dollar General will never be able to build a Dollar General, a new one right now, for what we're actually paying for this one. So all of our Dollar Generals are way below replacement cost, and it's irreplaceable rent. When we're looking at rent less than $10 a square foot, Dollar General cannot build a new Dollar General for $10 square foot rent anymore. So these are locations that they're going to want to keep because they're the top performing locations based on foot traffic, which usually translates to sales. And also $10 rent is a premium rent for Dollar General in a good performing store. And so these always have the least closure risk. And since they're top performers, the side effect is they're going to be easier to sell too, because of course,
everyone else has the information too.
Yeah, everybody else has the information, and people know that, okay, I don't want to buy this Dollar General that's like the
bottom one.
The bottom one. I want to buy this Dollar General that's doing a lot better now because the technology has changed and we're able to figure out which ones are the top performing Dollar Generals, because Dollar General doesn't release certain information. Like Dollar General does not release store sales, just as a matter of practice. And so you have to translate foot traffic into sales, into performance. And so that's how we make our decisions.
Yeah, and when we're looking at the locations as well, we really try and buy the standard store. We've talked about before, Dollar General has 18,000, 19,000 stores. So there's a lot that are non-standard, but this one is a standard store. It's built on a 1 acre lot. It's the 9,000 square foot footprint. It was built in 2009. So it's relatively new on the grand scheme of things. And it's a nice looking, clean location.
Yeah, and by the way, Dollar General did break 20,000 stores. So there was over 20,000 stores in the United States. It's crazy, isn't it?
That is. Wow.
Yeah.
All right.
Yeah. And they're growing. So they're right now, I think they have 800 stores planned to open up this year, where other retailers are shrinking.
Yeah.
This one's growing.
Yeah.
So you talk about winners and losers. Dollar General is the winner.
When we look at our business strategy here, obviously interest rates are higher right now. So debt is more expensive. And that has led to being able to acquire things at a higher cap rate. But we at least have a spread on that to make positive cash flow now and be able to earn a quarterly distribution that can be paid out. Overall, long term, we look at things just we're tying things to the term of the lease. So if we go out 5 years, at least goes until 2029. And at that point, we would look at like any other deal we have, we're going to look at, can we refinance and hold it, or should we sell it? Our target right now would generate a mid-teens return on our IRR spectrum when we go through the whole deal. So we're excited about that. That is positive for really any retail deal that you're going to find right now. So like that, things that would make the deal even better. If between now and some point in the next 5 years, interest rates improve, the deal would even get even better.
And
Right.
also remember too, cap rates had a little bit of a bump up recently because of interest rates. And so once interest rates go back down, cap rates are going to have their bump back down, which is going to make the value of this higher. And so, our overall exit, we hope that our cap rate exit is going to be, a lot better than that 12 or 13%.
Yeah, we're buying it at an 8.7% cap rate right now. We'd love to be able to exit it in the sevens, and that's where we feel things would be if rates correct a little bit, or if there's just added stability in the market.
Yeah, and Dollar General, just as a tenant, I mean, it's a remarkable tenant. Dollar General is a sound company. I mean, you could read anything about it. It's a Fortune 500 company, which, I mean, that's a pretty big deal.
Yeah.
So that means its revenue is bigger than some countries, correct?
It's got a lot, but looking at Dollar General and their performance, there are headwinds that you think about in retail. And people are like, are people going to keep shopping? Why doesn't everyone just buy everything online? It's like, well, that's not really happening. There are a lot of retail stores where they've had challenges, and we've talked about that in some of our various deals and updates and that kind of stuff. But there's also retailers that are performing really well, and they have a strong outlook, and they are opening more stores. And the Dollar General business plan fits right in line with that.
Right. I mean, you're not going to buy milk and eggs on Amazon. And so, and if you live in a rural area, Dollar General is strategically placing all of its units in areas without major grocery. And so it's the grocer in the area. And so instead of driving 25 minutes to the big grocery store, you're driving 5 or 10 minutes to the Dollar General buying milk and eggs and then going home. And it's a lot more convenient. And it's how rural America right now is shopping. And last year, Dollar General had an increase in sales. Their sales went up 4 to 5% last year.
Yeah.
That's pretty remarkable in a year when other retailers are
And they
shutting
keep
down.
growing.
Yeah.
So that's why we like Dollar General. We've talked about that a good amount, and we're excited about it. This deal in general, again, the 8.7% cap rate, that's really what we're buying it on, knowing that we have a lease in place until 2029.
Right. And just when you buy a property, I mean, there's always a saying, you make the money when you buy. And we're buying this at a remarkable cap rate that we have not seen in I haven't seen it in a decade.
No, especially really on any retail deal
Yeah.
front that we've had. We have not been able to acquire something for such an attractive cap rate. So we're excited about making just the consistent quarterly cash flows that will come from this deal, and we're excited about the prospect of what this could look like in 4 to 5 years. As the market does improve, we expect to see that happening. But right now, it's a great opportunity to buy a high cash flow deal.
Yeah, and just some quick metrics. We expect in year 5, this is going to be producing spin-off cash, like I call it beer money usually, of money in your pocket. It'll it'll spin off about 6% cash. So that's in your pocket, not including principal payoff. And then also when we exit, we're expecting around a 12% minimum, and hopefully we get into like the 15% if we have some cap rate compression, or possibly better depending on where cap rates go. But this is going to be a solid investment, a solid return. And, of course, I'm going to put my money in it too.
Yeah.
So.
Cool. All right. Well, that is the recap on the Dollar General in Sylvania, Alabama. Please let us know if you got any other questions on this one. We are very excited about the unique opportunity to be able to get a high cap rate, high performing location into our portfolio.
Thank you.
Thanks.